Top three things in my notebook this morning. Number one, the US dollar. Number two, the bond market, or the 10-year bond yield specifically. And finally, number three, China. So first, on the dollar and the 10-year, really, these are the two of the same bedfellows in this case, because we, of course, have the jobs report. The jobs report was good. So again, the jobs report, good again at the end of the cycle. The question is, was 5.6% on the unemployment rate the cycle low? We'll see what happens today. Watch the dollar and watch the 10-year bond yield for signals. US dollar obviously has been driving a tremendous amount of correlation risk in the marketplace really for the last week. If you go back to the GDP miss of last Friday, when bond yields hit their lows of 1.65%, the dollar started to weaken, and now this very pervasively weak dollar for the last week, which you can see on that chart, has really given birth to a counter-trend reversal in all the sectors that had been acting horrendously for the prior 3 months. So again, that's what it is. Watch the correlation risk in the dollar. I'm happy to do what Mr. Market tells me to do on that front. And again, I think that that's how you read the jobs report as opposed to reading the headlines. Point number two, same thing on the 10-year bond yield. The current risk range, I tweeted this morning, but I said a good jobs report could get you 1.89% on the upside of 10-year yields, and it can equally get you 1.64% on the downside. Now, what we have seen, and you've obviously noticed this, for the last couple months, doing the exact opposite of the immediate term called 3 to 6 minute reaction of jobs and GDP reports has been quite succinctly the thing to do. So again, watch out for that. Again, I'm more comfortable managing what is a trending and bearish risk range in the 10-year bond yield because again, I'm looking at things that are starting to trend the wrong way, which would include jobless claims, ADP, Challenger jobs report, any kind of jobs component of the ISM, which we obviously got on the services side earlier in the week. So again, the risk range is 164 to 189. I suggest you risk manage that accordingly. Finally, on China, which you'll hear nothing from on the mainstream media side today. Again, financial media is worse than left-leaning political media. If you look at it for what it is in terms of its coverage, they will not cover things that are negative. They won't talk about GoPro today. They will not talk about Pandora. They will not talk about Yelp. They will talk about the stocks that are up, and they will definitely not talk about China because Chinese stocks are down for 8 out of the last 9 days. Chinese stocks down another 8, really 1.9% last night. Have gone to down almost 5% for the year to date. And as we signaled yesterday, they've already broken what we call intermediate term trend. So instead of buying Chinese stocks on dips, what you'd be doing is selling the rips. And those are your top three things.